What's at stake as investors gear up for that crucial Fed meeting next week? Let's bring in CNBC contributor Shannon Saccocia of SVB Private, Alicia Levine of BNY Mellon Wealth Management. Ladies, great to see both of you. Alicia, to you first. So where does this leave us heading into next week?
So look, we sold off dramatically this week, headed into a Fed meeting, which is more or less consensus at 75 basis points for Wednesday's announcement. So in some ways, we've de-risked the Fed meeting. A lot of negativity here. Obviously, the data is not supporting that soft landing yet, forcing the Fed to possibly go higher. The market's already pricing in a 4.4% terminal Fed funds rate. If it goes much higher than that, if we get above 4.5%, I think we could see further downside to the market. But as it relates to the FOMC next week, I think we've pretty much de-risked that meeting. I mean, there's a lot of negativity. Yeah. We've already taken price action down.
Yeah, it depends who you are, though. I mean, there's some who say that the Fed just increases its risk every time it does anything or speaks because it's more hawkish than it should be. You have calls, Shannon, big decline calls, Minor, Dalio, Gundlach. You agree with any of them that stocks can go down 20% from here for a variety of reasons, including aggressive Fed?
Well, there's always an opportunity for stocks to fall, especially when there's this intersection of so much risk. But I think 20%, and the time frame is important, Scott, with these calls. We're really hearing for that to be really over the short-term time period between now and just before the midterms. That seems not necessarily supported, in my mind, based on just earnings where we see them today, some of the economic data. But I think what the important point is here is that is the Fed being too aggressive? Because just as they did coming into this, where they thought that inflation was transitory, they were not anticipating or adapting to the fact that we saw a lot of producer prices rising much quicker than CPI was at this time. I think the mistake the Fed could make, and why I think there could be a significant decline here, is if they get too aggressive based only on the CPI print, and they're not looking at those secondary and tertiary data points, such as prices paid in the PMI, for the improvement that we are seeing further upstream in the production process.
I want to talk about technology for obvious reasons. It's been a rough week for NASDAQ, Alicia. Jim Cramer just on with me. These stocks, speaking of mega cap tech, these stocks are the most dangerous stocks on earth. Says he still likes stocks, just not tech ones right now. What about you?
Look, tech has been really tough, and it's been tough because pretty much the long duration names in the equity market, which are tech, are following what's happening in the bond market. So the equity market has been dependent on where yields have been going here. I think what's interesting in some of the price action today, if you look under the hood, the more speculative names, which had huge selling earlier in the year, have more or less stabilized. And now you're taking down top of house. Top of house, which supported the S&P and which really was the place that people were hiding to be exposed to tech and not be exposed to these more speculative names. Those are the ones that are coming down. I do think there's still risk there. And as I said, if the 10-year breaches 3.5%, there is another leg down there. But I'll say this, it's getting tempting. And because now we have the earnings cycle starting to move lower. And it's kind of baked in that earnings must move lower because we are headed towards a cyclical slowdown. Once that happens, then tech will be the place to go to because yields will come down. And that's where you want to be. But you got to get
Shannon,
from here to there. And it's not really a pretty picture to do that.
Understand. Shannon, your take on tech, big tech. I don't want to talk about, once high flying, ARC-like names. I want to talk about the biggest, most heavily owned names in this group. Are they the most dangerous to own right now because of where rates are, what the Fed is likely to do and say?
Over the short term, I can certainly see where there'll be some pressure, Scott, but I certainly don't think they're dangerous. Companies that can engineer their own earnings, that can grow their top line in an environment we're not going to see significantly strong secular tailwinds from a growth perspective, for me, I have trouble seeing that as the most dangerous place to play.